Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of the Beginner's Guide to Convertible Bonds. Are you looking for an investment that's both safe and exciting? Convertible bonds might just be your ticket. These financial instruments blend the reliability of bonds with the growth potential of stocks. In today's market, investors are constantly seeking hybrid solutions that balance risk and reward, and convertible bonds fit this need perfectly. So, what's the deal with convertible bonds? Simply put, they start as bonds and can turn into company stock if the opportunity is right. This gives you a steady income with the chance to benefit from a company's success. Perfect for those who want the best of both worlds. In a financial climate that's always changing, understanding convertible bonds opens up new avenues for smart investing. Let's explore how these unique tools can diversify your portfolio and make your financial strategies more dynamic. What are convertible bonds? Convertible bonds are a fascinating investment choice that offer the stability of fixed income returns with the potential upside of equity growth. They serve as a bridge between the cautious world of bonds and the exciting potential of stocks. Definitions and key features. A convertible bond is a type of corporate bond that can be converted into a predetermined number of the issuing company's equity shares. This hybrid financial instrument has some distinct features. Conversion ratio. This tells you how many shares you can get for each bond. If the conversion ratio is 50, then each bond can be swapped for 50 shares. Conversion price. This is the price at which the bond can be converted into stock. It's calculated by dividing the bond's par value by the conversion ratio. Say the par value is $1,000 and the conversion ratio is 50, then the conversion price is $20. Maturity. Convertible bonds come with a specific maturity date. On this date, if the bond has not been converted, it either gets repaid to the investor at face value or converted into shares, depending on the terms. These features play a crucial role in determining whether or not conversion is beneficial based on the market conditions. How convertible bonds work. The operation of convertible bonds is marked by a predefined process that outlines how and when conversion can occur. Conversion options. Investors can choose to convert the bond into stock at any point during the bond's life, also known as its tenure. This choice gives you the flexibility to benefit from rising stock prices while still enjoying the bond's interest. Timeline of bond maturity. Convertible bonds usually have a lifespan of several years, often between 5 to 10. During this period, bondholders receive interest payments, typically every 6 months. As the bond approaches its maturity date, the decision to convert depends largely on the stock price compared to the conversion price. Convertible bonds are popular among companies looking to raise capital without immediately diluting their shares. Companies use this strategy to entice investors with the potential for future equity, while investors are drawn to the dual benefits of regular bond income and potential stock appreciation. Thinking of convertible bonds like a Swiss Army knife can make sense. Adaptable yet straightforward, offering multiple options within a single investment. Types of convertible bonds. Diving into the world of convertible bonds, it's crucial to understand the various types available. Each type offers unique conditions and potential benefits, matching different investment strategies and goals. Let's break down the main varieties you might encounter. Vanilla convertible bonds. Vanilla convertible bonds are the simplest and most common type. Think of them as your straightforward convertible bond option. They function as traditional bonds, paying regular interest, and can be converted into a specified number of shares of the issuing company at the holder's discretion. Here's what makes them stand out. Simplicity. These bonds don't have any complex features or conditions. They offer a clear and predictable path for investors looking to dip their toes in convertibles. Flexibility. You decide when to convert your bond to stock, allowing you to capitalize on rising stock prices while enjoying the stability of a bond's interest income. Clear terms. The terms like conversion price and ratio are specified upfront, making it easier to calculate potential returns. For those new to the convertible bond market, vanilla convertibles are a great starting point due to their straightforward nature and ease of understanding. Mandatory convertible bonds. Unlike vanilla bonds, mandatory convertible bonds require conversion into equity at a specific point in time. They're structured to ensure that conversion happens automatically under certain conditions. Here's a closer look. Preset conversion. These bonds aren't left to investor discretion. They convert into stock on a predetermined date or when specific targets are met. This mandatory conversion means the bondholder becomes a shareholder on the issuer's terms. Attractive to companies. Issuers often offer higher coupons or enticing terms to make these bonds appealing. Companies like these bonds as they help manage debt and equity strategically. Limited flexibility. You trade off some flexibility for the potential of higher returns. It's a more defined path, but it can work well if the company is performing well and the market conditions are favorable. These bonds are like a ticking clock with a set endpoint in sight. If you're comfortable with this certainty and potential for growth, they're worth considering. Contingent convertible bonds, COCO bonds. Contingent convertible bonds, or COCOs, are unique because they convert based on specific triggers, often tied to the issuer's financial health. They're typically seen in the financial sector. Let's unpack their main features. Trigger-based conversion. These bonds convert to equity when certain financial metrics are hit. Triggers might include the company's capital ratios or specific economic conditions. Risk management. They serve as a cushion for financial institutions, turning debt into equity when stability is threatened. It's like having an insurance policy that kicks in only when necessary. Higher risk, higher reward. While they offer potential upside, COCOs carry risks due to unpredictable triggers. They might appeal to those who can handle the volatility and are interested in higher yield opportunities. For adventurous investors who understand the financial ins and outs of issuing companies, COCOs can add an intriguing layer to their portfolios. Advantages of convertible bonds. When exploring investment options, convertible bonds offer a unique blend that attracts both conservative and aggressive investors. They provide an enticing combination of security with the potential for profit, making them a compelling choice in diverse market environments. Potential for upside participation. Convertible bonds offer investors a chance to taste the equity-like returns while enjoying a safer starting point. Imagine buying into the promise of a company's growth without diving headfirst into the volatile waters of the stock market. When the company's stock performs well, convertible bondholders can convert their bonds into shares, capturing significant gains. This potential for upside participation is appealing because it allows investors to ride the wave of market success without facing the full risk of stock ownership from the start. Downside protection. Think of convertible bonds as your trusty safety net. They're designed to protect you when the market goes south. Unlike stocks, which can see their value plummet, convertible bonds promise regular interest payments and a return of principal upon maturity. This built-in downside protection means even if the stock conversion isn't appealing at the moment, the bond aspect provides some security. It's like having a parachute when jumping off a cliff. You can enjoy the thrill, but have a backup plan if things don't go as planned. Lower interest rates. Companies find convertible bonds attractive thanks to the lower interest rates they can offer compared to traditional bonds. This sounds like a win-win situation. Businesses get to save on borrowing costs, and investors receive compensation in the form of conversion opportunities. When an issuer needs to raise capital but wants to avoid high-interest burdens, convertible bonds become an invaluable tool. The promise of future conversion adds value for investors, justifying the lower interest rates. This financial dance lets companies leverage future potential for present needs, maintaining competitive advantages without overwhelming debt. In this dynamic between issuers and investors, convertible bonds serve as the bridge connecting financial stability with opportunity. Risks associated with convertible bonds. Investing in convertible bonds can be enticing due to their versatility and potential returns. However, like any investment, they come with their own set of risks. Understanding these risks is crucial for any investor looking to make informed decisions. Let's break down the main types of risks associated with convertible bonds. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.